we met way back, probably 10 years ago. I actually tried to recruit you for Viva Real, and you intelligently went to Movile or iFood and all that, and you're on that journey. I think actually probably I tried to recruit you more than once, but
No, I was there. I mean, iFood was such an amazing experience, and I wasn't. I helped do the deal where Movile invested into iFood, and so I was long term invested in that, and I continue to this day to be a partner there. So yeah, it was always a dilemma of when is the timing right to graduate out of that, and I think when we talked, it was just too early. I was super
yeah,
enthusiastic with your energy and where you were going, but it didn't match where I was. The
no,
stop
you
wasn't
had a
there.
lot of fun, complex things to manage while you were at Movile and with iFood, and then the whole kind of network of companies, the M&A activity, like
The defense
as
against the company you funded,
exactly.
where they raised $1 billion, and I had to go in and drop down and become interim CFO of iFood to figure out how we're going to respond to this. So yeah, it was actually very fun times. But unfortunately,
Yeah.
Deus there, went super well. So
Well, listen, you've had quite a journey. Started your career in finance, working with equity and bonds back in NYC, and then you've kind of traveled the globe here, spending a little time in India, working in real estate investing, and then down to Brazil at a hedge fund. So, what made you want to change sectors and move to emerging markets? And what's that experience been like? I mean, you've been in Latin America for a long time now.
I say this, these kinds of questions are deeper than they look on the surface. It's like, how do you choose what you do? How do you make life decisions? And when you look at it like that, it looks like you're like, what's the coherent theme there? But actually, it's not I didn't start on Wall Street. I started as a submarine officer. So I lived on a nuclear submarine for 3.5 years. I was in the Navy for 5 years. And that's what got me into business school. Fast forwarding a little bit, eventually I had to pay the bills after being a government worker for 5 years and being jobless for another 2 more years as I was at HBS. So sales and trading for various reasons was there. But as I look at why or what I was seeking, I think I was always interested in solving very hard problems or doing things that were just very, very difficult. And maybe it's part of like proving to myself, something from childhood or whatever. And so, if you look like submarine officer to Harvard Business School, which itself was very challenging, to eventually Wall Street, to India, to Brazil, there's that theme there of an entrepreneurial spirit and tackling like hard, interesting things. And so nothing's changed in that sense. I think I continue to be extremely entrepreneurial and tackling hard things, but you grow and you do it with maybe less stress. Maybe you're more thoughtful about what you choose to tackle there. But yeah, expanding on your question, I think it is interesting because something I think a lot about is like what produces entrepreneurs, and and I about a year ago, maybe it's been more than a year, 2019, I did a course at INSEAD called Challenging Leadership, where you learn psychoanalysis and apply it to business. And so they talk a lot about this, like how do people take decisions, and those who go on to become entrepreneurs are generally produced in their childhood, actually, like where they become very used to change. And it can be like maybe traumatic, or it can be just simple things. In my case, yes, I don't know, but I at one point my dad and my mom moved from New Orleans to Lafayette for the oil industry, and I wound up changing schools 5 times in 5 years, between ages like 6 and 11. And so, you became very accustomed to just dealing with change and disruption. Yeah. Also, if you look at my theme, especially where I moved from the U.S. to India to Brazil, I was in the Navy. There's this desire to want to see the world. In my case, I had an uncle. It's almost like he was actually a Spanish speaking guy. So it was a true Chio in the U.S. They don't have this very often, where you're calling someone an uncle or aunt who's not actually related. And I always thought it was weird, but now in Brazil, everyone calls me Chio. I guess I'm old enough to be a Chio now. So we had Uncle Lewis, and we were I'm pretty sure actually he was a CIA spy, but he would tell us stories about how he traveled to Afghanistan in the 60s and 70s, or to Eastern Europe, Antarctica to install a reactor for heat there, and all kinds of crazy things. So a combination of these things of having the bug to want to see the world, and really being comfortable with risk, with getting out there, contributed. And I think then the question is, why settle down? If I was on this path of like traveling and progressively doing more and more wild things, why stay now in Brazil? I came here in 2009. And it's really just an amazing market. Also, one of the things I discovered in India, I was living with a Sikh family, because there's no single person housing in India. The concept of being a single person living alone doesn't exist in India. The kids stay at home, and so and work from there and get married, and the son never leaves home, and the wife moves in. These kinds of things, and so when I was there doing real estate private equity as kind of a sabbatical in 2008, I found a house and lived with a Sikh family. And and it was very hard. But one thing I really liked is this concept of it takes a village to raise a child, and extended family. And so when I decided to get married to my wife, Priscilla, I'd met in New York, continued to date while I was in India, going back and forth. We decided to get married, and rather than move back to New York and schlep up and down the subway with a stroller, which is fine and admirable, I said, even crazier, why don't I move to Brazil and live close to your parents, and they can help us, create the family. And that really worked. I mean, the crazy part is I didn't speak Portuguese, so then moving here, I had to find a job that didn't require Portuguese in Brazil. You know how hard that is. But I had found two amazing guys who were spinning out of Safra, who wanted to start up a family office, and I helped them build the offshore part of their fund, and I could speak English and learn Portuguese. And so all of that worked. So I was able to move here. It really did help in having Priscilla's mom and dad around to raise our kids. And now I have two beautiful children, 9 and 11. And then there's just so much to do here. And I love the paradox and complexity of Brazil. And I kind of say it's like, this is a place where, the laws routinely change. The politics is a little crazy. But at the same time, it has one of the most sophisticated central banks in the world. I think it has the best one, personally. I think even better than the Fed in some ways. They raised rates much faster here. It has the most well-functioning banking system in the world. You go to the US, it's like a little bit barbaric to send money in Brazil. It's so amazing that people are now copying PIX and things like that. And it's also a very large market, like over 210 million people. So it's a place where there are things to do. You can identify it, but and it's large enough that if you do it well, you can form a business. And I have family here, I have staying power, and so I kind of found a place that worked, and I've been here since then, and not going anywhere. Now, later on, we'll talk about bamboo, but super excited with the business we're building today.
That's amazing. I got to ask, how do you get a job working on a submarine?
Wow, that's interesting. Yeah, well, I mean, I was a computer engineer in university, but actually, you have to apply. Well, you have to have be in the Navy some kind of way. So I got a Navy scholarship to university there. So how do they pick those people? I was a Boy Scout. Maybe not a surprise.
What compelled you to want to be in a submarine for 3 years?
Yeah, you're better at drawing these things out. Well, I mean, what compelled me to join the Navy is I grew up in New Orleans, and New Orleans is like a little Brazil, and imagine like, how do you graduate out of that? So I didn't know how. I knew I wanted to see the world, but I didn't have very good answers on how I was going to do that. And I wanted to go to a really nice university, and kind of grew up in middle class setting, so that I was destined for state school if I didn't find a scholarship. And so I applied to the Navy ROTC program and was accepted by the grace of God, I think. And then I studied engineering, and there, it depends on what you want to do. If you're going to take that kind of scholarship, you have to do something that is actually war fighting. Like they don't let you go be a naval intelligence officer or something. And so your choices are SEALs, uh, surface, like being on a ship, flying a plane, or doing submarines. And I think submarines just had the combination I liked. It required a little bit more commitment. Like I had to do 5 years. If some things you could choose would do 4 years, but not so much. And also kind of funny. I joined the Navy, but I get motion sickness. And so the surf, being on a ship and being in a plane are really painful sometimes, especially a jet plane where you're flying around and stuff. And so submarine's actually quite stable, and the people are amazing. I mean, you're dealing, half the crew is trained to run a nuclear reactor. The other half hangs out with people who run a nuclear reactor all day. So even if they just do the plumbing, they're actually the most intelligent plumber you've ever spoken with. And it's a high trust environment. Everyone has a security clearance and so forth. So it was really good. It was some of the best people I've ever worked with, actually. And, I guess the thesis worked, actually. I kind of said, well, I'm going to go do this. I'll figure out my life. I'll work really hard and I'll do a good job. And let's see where this goes. I have this dream of going to Harvard. And they wrote my recommendations for HBS, and I got in. And there, when you get to HBS, in the Navy, in the nuclear submarine Navy, you're taking a test a week, right? Because this is a service that does very risky things. You're operating a nuclear reactor next to things that could explode in very, very high pressure, literally and figuratively, circumstances, and yet they have had almost no problems, and no accidents that have released radiation to the public, for example. And so you take a test a week, to keep proficient. And when you get to business school and you're able to learn things like you choose what you want to do, it's just a dream. So fascinatingly, I didn't know what investment bank was when I went into Harvard. Someone had to explain to me that there's this thing that doesn't take retail deposits. And I left graduating with the finance award from HBS, which is the highest grades in finance, and it comes with a monetary award. It's actually, in the end, was a retroactive half scholarship from just loving what I was learning and being dedicated to it. So it served me well. Actually, I'm very grateful for the Navy experience, and yeah, it's kind of funny.
What are some things that you learned being in the branch of a military that you apply to your kind of business lessons or how you operate as an executive?
Oh man, what I
What?
say is, like, when I got to Wall Street, I'm like, oh, I forgot the feeling of being shot at. Like the closest experience I had, I think, like, being in the military and being on a sales and trading floor was like practically identical in some ways, like the stress and so forth. So you learn to be able to take decisions very quickly. You learn to deal with risks. I think as you get older, you also reflect back and think about, wow, if I would have stayed in, I'd actually be the captain of a submarine. And yet, as you get older, you say, well, I don't feel much different than I felt at like 18 or 20 or 30. But I have to remember how I looked at them. And so it gives you amazing role models of, like, well, who do you want to be? How do you want to be? Sometimes you need to be the adult in the room, even though mentally you could choose not to be. You have to look around. If no one else is equipped to be the adult in the room, you're the adult in the room, and so then you have to step up and make hard decisions or serve that role. And it helps with that. Anyway, so you had asked about Wall Street. So then after, in HBS, I was doing incredibly well in finance, uh, but my previous experience was the military, and so I was not going to get a job in private equity or venture capital, no matter how much I would want it. Like, I wasn't going to compete with someone who'd done 2 years analyst at Goldman and then another 2 years at KKR or whatever. But a place where you could go that really appreciated the ex-military experience, and also where the MBA was actually differential because it wasn't so common, was in sales and trading. And also, as I mentioned, I've been a government employee for 5 years and without a job for another two. So I would pay back my student loans quickly, and was also something I was really interested in. As I mentioned, I graduated #1 in finance at HBS at the time. And so I picked it, and then it's worth noting, like at HBS, I'd written my application there about how I wanted to study under a guy who won a Nobel Prize in economics, Bob Merton. And he won it for kind of inventing the option pricing methodology, how you price options. Sometimes it's called Black-Scholes, but sometimes it's called Black-Scholes Merton. And he actually named it Black-Scholes, a very humble guy. He didn't want to name it after himself. And so I studied under him, actually. I mean, I really did what I said I was going to do, and loved that, and had an amazing capital markets experience there. So I did sales and trading for a year at Credit Suisse, and then decided to move to the buy side. And actually worked for Merton's firm for another year. Starting up a credit hedge fund at the time. And then I moved to be CFO of a convertible art shop, where I kind of started to understand how do the capital markets work. All this experience took me to 2008. And by then I was a hedge fund CFO kind of very quickly. I was kind of organizing the business side, but still doing special situations investing. And frankly, I saw a lot of the things that you see in the movie, like The Big Short or whatever, and said, this is going to be really interesting. I should learn a different career because I don't know where this is going to go. And so I decided to move to India and do real estate private equity, just in case. And did. I had a friend who I'd studied with HBS, who started up a fund there, and I came in and was the COO. And then, as I explained, when I decided to get married and cut India short for that reason and come to Brazil instead, I was moving languages and geography, so I needed to go back to something I was reasonably good at. And so I became a hedge fund CFO again. So I left. I did that experience. I really got to know the capital markets, but ultimately I was in the capital markets in Brazil, and kind of came to the conclusion for the age I was at that I wasn't going to have an edge there. And so I said, well, instead of investing, why don't I be invested? And so I moved to the other side of the table and became a CFO of a company that needed money. And I'll stop there.
Movile was an important part of your journey, and you started as a CFO, and you led a lot of strategic stuff at Movile as well, acquisitions.
We did around 40 mergers and acquisitions. We did around
40 deals.
40 deals.
So let's talk about that a little bit. Let's talk about acquiring companies. What are some of the things that people maybe get wrong about, one, acquiring companies, and two, being acquired?
Yeah, I mean, Fabrizio, my partner, was CEO of Movile. Now he's today doing an amazing job running iFood. He had written his thesis on M&As for his master's degree, and so Fabrizio is really good at kind of like distilling things down to very simple things. And he would say, a deal gets done when both sides want it. And I think maybe a lot of deals die just because people don't really take the time to look and see, well, are both sides really, really eager for this? Or it's really frustrating because the other side's doing things to kind of frustrate the deal, and doesn't want to be there. But then, when does it make sense to do a deal, and what kind? The kinds of deals that Movile was doing were really about reinventing the company, because the Movile that I came into, and I came in with eyes wide open. It was selling content over feature phones, so the model of phones before smartphones, and working with the telcos as partners. And then we looked around the world, and we knew that model was of limited days. It wound up lasting more than anyone imagined. It took 3 years for the B2C business to really go away, and then to surprise, the B2B SMS distribution business actually grew incredibly well with two-factor authentication and other things. But we were frankly taking the profits out of that and investing in next generation use cases of the mobile phone. And we were also trying to do organically. Movile was a content distribution company, so it started up like kids. But what I kind of learned is inorganic oftentimes is really the best answer. Inorganic meaning we went out and invested in things, and we weren't geniuses. I think we tried different things, ticketing, mobility, but food delivery went incredibly well. We made a minority investment in iFood and then looked at the data and kept funding and funding. And then we also applied our own medicine. We helped iFood do M&As. They did a different form. So they did roll-ups, where roll-up is where you have a very clear platform and you're bolting on really to get access. And that wound up being wildly successful. So iFood expanded into many cities by buying effectively the contracts that the target company had with the restaurants and having an amazing earnout for the people there to guarantee the success of the transfer of the contracts. And we did that like 20 times and built a national champion there. So I don't know. What I learned is reinventing is hard or bittersweet. Today, now, was announced like a week or two ago. Movile is now rolled up into iFood, so that the child ate the parent in some ways. But it was a successful strategy, and roll-ups are much less risky than trying to reinvent yourself. By this. So, even in that process of reinventing yourselves, we eventually then had to divest other things. And so, maybe the bittersweetness is that it was successful, but very few people are left from that original group. Fabrice is there in iFood, and some other people have moved there too. But most people wound up in different places, me included.
How do you think about making a minority investment versus acquiring the entire business? One of the hard things that I've seen with some companies is, and I think about this at Viva, we made a couple acquisitions, not 40, but 4 maybe. When we did a deal, like sometimes we looked at maybe like investing in a company, but then there would be a weird conflict where you're all of a sudden like, you kind of want to own it, but you want it to be successful at the same time. How do you manage those challenges?
Yeah, I think you have to think in both directions. Like, maybe sometimes start at the other direction. Why would the other side want a majority investment, or why would it want a minority investment there? Yeah, another way of asking is like, when is it time to sell? And uh, this actually came up very recently because I'm going through Endeavor Scale Up right now, which again is another funny situation. I was Endeavor mentor for many years, talking about M&As and fundraising. And a year ago or so, they invited me to become an Endeavor ambassador. So I increased my affiliation with Endeavor, if you want to call it that, and became an ambassador. And then subsequently started Bamboo and applied to Scale Up. Scale Up's been an amazing experience where they really try to pair you with mentors to help you in your business challenges, and then also with peers where you have discussions. And then me being now over 40 and kind of a second time entrepreneur, my peers are also, slightly older and more experienced. And so they're having these existential questions of like, when do I sell or not? And it's kind of like a forum or maybe group therapy, whatever you call it. And one of these, really came to the conclusion of who didn't need to sell was like David Velez, who's done an amazing job at Nubank, because he tackled a market where no one really wanted to touch. To his credit, to the team's credit, there they really went after a market that was underserved and had no clear competitors. They would say, no, we had competitors, but I mean, it wasn't highly contested, not by the big guys, and so they were able to live for a very long time and eventually make it to being public without having to sell. And so the further you are from that, the more likely it is that you're going to have to do a full sale, or if you're the gorilla, then you'll be acquiring those kinds of businesses. So, flip side, if instead of that, he would have started up a business where he was going after the same kind of uh, base that an Ito Bradesco would have. Eventually, they would wake up and have a strategic response, and unless he had like incredibly deep pockets, it would probably result in a sale. So if you find yourself in that situation where you're really competing over capital, and the market is just not willing to fund you, that's a time to do a full sale. There's also personal considerations. If you know you're if you're at the end of your journey and there's not a clear successor, or you have a business that's no longer VCable, that's also a fine reason to sell. And then in terms of minority investment, if you're looking for help but you don't need to sell, then it could be a minority investment. One of the things I've discovered in some of my talks is the more regulated your business is, the more likely you are going to take a minority strategic investment at some point. Just the advice I got, and I'm not giving this advice. This is actually what I received. But you look at some of the guys who are quite large today. If you look at the history, you'll discover many of them had actually large strategic investors. For example, XP and Itaú. You want to have an exit clause, like to where you can eventually, amicably separate and continue on with your life. And of course, you want to avoid being subject to a right of first refusal. So in those cases, if you need a license or you need credibility, or if you need very specific insights or access that might lead you to a strategic deal, no shame in that at all. Just make sure you have visibility on how you're going to get out. And of course, then if you don't need any of those things, and you're doing fine and can raise venture capital, go for it.
So if you're an acquirer, you probably want the ROFR, you want the right of first refusal, and if you're a seller, you don't want it.
Yeah, I think but I think people need to be much. I mean, I was the managing director of M&A effectively. I think most people you can have a real conversation with and say, look, are you just trying to buy me, or what do you want to get out of it? So you need empathy on both sides and say, look, I'm not doing a sale. If I was selling my company to you, it be that, is this a financial return? So both sides should have reasonable expectations. One side should be very clear, like, look, I'll give you an amazing financial return. Maybe there's an out to you, and we'll be close enough to where we can have that discussion. But if I give you that right of first refusal, the colloquial ROFR, I'm never going to be able to raise money again, and that's not going to be good for you either. I'm highly unlikely to take that deal, or that's going to be the last deal on earth that I'll think about, and I'm going to shop this all the way around. You can say that more nicely. So, generally, I think good corporate development teams really understand that, and absent being cute and trying to throw that in there, that very quickly gets ripped out.
What's too much secondary to sell, and how should founders be thinking about secondary transactions? The first time I sold secondary, I think I sold a couple $100,000. I remember sitting around the table with a bunch of other entrepreneurs that had been grinding it out and were at Series A or whatever. And they were so fascinated. They're like, how did you sell? How much money did you make? Because a lot of times you're kind of starving as a founder and you're not making a high salary. What is too much equity to take off the table where you're not sending a signal? And how would you conduct a secondary transaction as a founder in order to put yourself in a better position?
I mean, I was always on the other side of kind of organizing it. But I think it starts by asking, the investors coming into the round, or, trying to set that as part of the term sheet. Like, hey, as part of this round, I'm looking for, this amount of secondary. It's modest. I think.
How do you position it so it's not a negative signal?
I think most people are real, like I'm telling you this story, like, man, I remember those days. I mean, I could say like at one point, I actually got to the point where I hit like credito consignado for like, and I was in that window of 10 days where you could pay it back for free. And thank God, the money fell in my account that I was able to like get out. But I never wanted to go back to those days again, and that was not productive. It didn't make me work harder. That made me like a very nervous person. So I think asset allocators understand that, and maybe they're going to ask like about your finances, and you can explain or so forth. But I mean, like, I don't know. It depends on the size of the business and obviously the size of the round. But up to this might sound like big numbers, but up to a couple $1,000,000 is not going to give the guy enough cash to like be able to disappear. These are really like totally personal opinions, I guess, but like what gets excessive, just get close to like 10 million and above. I mean, they're really like the person has enough money to not have to work, and you have to question like why, like what are you buying, and is that going to be a distraction on the business you're doing, and all of this. So I would say low single digits, no problem, provided the round size supports that. If not, 5 5 to 10% of the round, perhaps, and go from there.
Tell me more about your thought process, because you clearly had enough capital to fund Bamboo, but you took my check, and you raised the money from some other investors as well.
Yeah.
What was the rationale for wanting to have other people around the table with you?
Going back to what I said, is it takes a village to raise a family. It takes a village to raise a company. I mean, it's very similar to a child, and I think you can learn to be a parent by reading a book and kind of figuring it out on the fly. But it's at least interesting to get advice, and then occasionally, you, you want people that you can have vulnerable conversations with, or introductions. And so it was really about the network, uh, and and then it was incredibly important on hiring amazing partners. Everyone here at the stage has equity, basically, so that you be VC funded and validated, and that you commit to stage financing and valuing up the company, because people can make a lot more than you're paying them on the salary, multiples more on the salary, and so you really have to give value to the equity. And um, that requires a convincing argument that you are highly committed to VC funding and the governance that dictates, and the path that dictates, where at some point you're going to need to generate liquidity, and one way or the other, either a sale or IPO or buyback or something, but that people are aligned with them as well, where they love the experience, but they may not be here the whole time. And so having that made that much easier. We recruited people out of top tier banks. As a capital markets startup, we needed people who had worked in the capital markets. There had tons of opportunities out there, and so being VC funded was absolutely critical to that. And then, to give credit, it's not just about at that time, you allowed it to continue to add value in the events that you do, and that has direct business value. But I also need to make sure that the amazing partners that I have here get development, and so giving them forums to meet like-minded people, or even highly different people, completely different businesses. They find that very exciting as well. As you guys, Pedro Sorrentino at Atman has a different flavor of things, where he builds kind of like one of these working groups where you can have vulnerable peer exchanges. He calls it the egregore. That's been amazing, and he's also started up and had successful exits of a couple of VC firms, so he brings his experience there. And then GFC is a funny story. I mean, Alex Anton, I'd hired out of McKinsey, so I helped him get started in venture capital. But I competed against Oliver Zomer at Hello Food, and so I had met him a couple of times, a number of times. It was always somewhat hostile, and I wasn't sure. And it's he's the guy who ultimately signs the check there, and so the relationship with Alex can be what it is, but you're going to have to interview with Oliver and pass that interview. And so he I went, and it was actually very, very smooth. I think Oliver appreciated a good competitor, along the way, and we performed well, and I think he saw that. And Gypsy's been very, very good. They are extremely rigorous. Let's say more on the conservative side. So they called very early, the recession or the downturn, like assume zero funding for X years. Um, but they also are very risk tolerant, and if you need help, they'll give. So I'm very grateful for the lead investors that we have. You at
I guess it's
admin and
great to
GFC.
lesson to maintain good relationships even with your competitors. Having some
Certainly,
kind of
certainly.
frenemies. It's okay to have frenemies, and you never know when
Yeah, we wound up buying
when you
Hello
can.
Food too, along the way. So the world's very small. Don't don't ego identify into things. Keep it professional.
Let's talk about capital a little bit more. Let's dive into your current business. So, what made you take an interest in debt capital, and you created Bamboo? And what's that gap that equity investment can't fill on its own? Talk more about that.
Yeah, sure. So, I mean, look, as I mentioned before, I started kind of my second career post military was in Wall Street. So I saw all these inefficiencies in the street, but I didn't have the tools on how to deal with them. And then I spent 9 years building a platform company, and it took nearly the entire 9 years to finally like deeply, deeply understand platforms. And platforms are amazing, and they're so new. They're so new. This is like but they feel so natural that they feel like they've been around forever. But they're so new that on the streets here in Sao Paulo, you can still go around and find the places that you literally would telephone to call a taxi. They haven't been torn down, and they're still very new. The postal taxi, which were completely, of course, disrupted by 99 and Uber. And so that happened over these last 10 years. And so I think the experience at iFood gave me a tool that it could apply. And then the situation that I saw there also gave me a use case, which is when I was CFO, the team came to me at Movile, so CFO of the group, and said, "Hey, we see a need where we have these pizzerias. They're very informal. They may not even have a balance sheet. They certainly don't have any accounting, and but they have a great recurring business. They make amazing pizza. The customers love them. They've been in business for a long time, and the guy wants money to invest in a new oven or to reform the seating room." And we process the payment, and the guy delivers a lot of pizzas, so we don't see a lot of risk here, and we can diversify, and so we want to lend money to them. I said, well, that strategically makes sense because it also kind of endears the restaurant to you. They're very grateful, and they're less likely to churn out. And so I get it, and it also why you and not a large name bank. It's because they don't have processes to deal with someone who can't doesn't have a balance sheet. That person may not even have the network to arrive there and so forth. So I got it. I'm like, wow, that makes total sense. But there's a problem. It's like you're not a bank, and my indirect boss, the CFO of Process Basel, who's an amazing person, would always drill that down into us. You guys are not banks. Don't go out and do debt deals. Like, we invest in equity. It's like they're going to say we're not a bank. So like, what do you guys want to do? And they say, well, we want to go open up a fund to invest in credit rights. In Portuguese, you call that a fachiki. And I'm like, wow, I can totally imagine this having come from the capital markets, but that's going to be really hard, and how's this going to work? So anyway, long story short is they worked through it, but it really took a year. And I think they were really able to get it done because iFood was so big that it was able to piece together the minimum size, which is around 200 million. Now it's grown to around 300 million reais. But even then, the terms and the pricing was just really bad. I think, from a risk standpoint, the risk reward was highly skewed to the investor. I think it had very low risk for the investor and amazing return, and that piqued my interest. Going back to thinking about what I learned working with and studying under Bob Merton and Nobel laureates, this kind of asymmetry and irrationality in the market. And so I said, why is it that this thing priced the way it was, and why was this process the way it was? There's frictions all the way around, if you want to use financial terms. It took forever to do, and the end result was again highly inefficient for the company. It's because there was just a lack of data. What the investor had to take a decision was this data connection. Now, it didn't have a data connection. Was a PowerPoint, PDF, effectively, and a synchronous meeting, like this, where they had to judge the management, see how they rock their heads, and take a decision on investing, 200 million reais. So of course, they're going to price it extremely conservatively. And so, yeah, so when I decided to graduate out of all this and start out on my own, I knew I wanted to go back to the capital markets. And when looking for a use case of what to do in the capital markets, it really fell on this. And what is this? iFood was offering embedded financial services, and so also saw that as a trend. In addition to like the growth of fintechs, which we've seen over these last couple of years, what I saw was that there's missing an investment bank for this, and this is going to be a growing sector, and it's one that, for structural reasons, because it involves heavy investment in technology, the existing banking population is not going to be likely to solve. In addition to the fact that most of these companies will not be iFoods to start, they'll be much smaller. And so let me build the organization that can start with small deals and focus on helping investors understand the risk, so that I can support, what's called the structure, the originator, the distributor, in getting these deals out. And that's what Bamboo Debt Capital Markets platform is that we go and find deals that can, like debt situations that it's backed by assets of the company, and we structure those deals for distribution. Today, we also have the license to distribute deals that are done as a securitization, which is a special term in Portuguese, SEADs, CR. Those we now have a license to do, so we can actually distribute those as well. And it's going amazingly well. Our first deal that we structured was solar panel company. And I love this because we helped them raise 5 times revenues. Like, they never in their life would have ever been able to do that. And it was actually a very tiny deal too, which proved that we could lower the transaction costs so much that you could get a company to market. And then one of the investors in that was a startup fund. So it also proved the other side, where we were able to bring in new investors. That one has multiple tranches given the size of the borrowings relative to the revenues, so we can't divulge the name. But then yesterday we helped Agroforte raise 40 million reais. We structured that deal, which they then distributed with DTBM. And that one I'm extremely proud about. We had a high-end bank invest. We had a large top-tier multifamily office. We had a family office, and we also had an extremely top-tier fund invest as well. And it was a similar situation, without data to understand why this was a good investment. Agroforte structures, gives loans to dairy farmers, to egg farmers, to chicken farmers, and to pig farmers. And people would look at that and be like, "Wow, that's wild. Why should I invest in that? How is that safe?" And we were able to show that actually the way this is set up, and it has participation of the person who buys the proteins, um, the groups that buy the proteins from them, that these guys don't default, or it's very low. And, we set the level of subordination that more than compensated for that. And the deal got oversubscribed. And so there's also the ESG angle. Like, why are the guys borrowing? They're borrowing to buy equipment, to increase production, and so forth. So extremely rewarding. And again, I love that it's an off-Broadway company, using terminology from a friend of mine at Steamboat. He uses that to talk about these deals that you're like, where did that come from? Where did this company it's not super well known, find the means to borrow 40 million reais? And so it's going super well. And so we're looking for those kinds of situations. And the more we look, the more we find them. I mentioned some cases there: solar energy, ag tech. Clearly there's the classic credit fintechs, but there's also software companies that have recurring revenue streams where they can securitize those things, and so forth. And so, the thesis was that there would be more embedded finance opportunities. Either you're investing in receivables or the guy's creating an asset that has a long life. And the more we look, the more we find. So we've been incredibly pleased with the progress.
So are you just making this more efficient for both sides? Is that one of the things that you're bringing to the table? And then the second question, besides efficiency, are you seeing this from a perspective where there's a unique angle in Brazil specifically that makes bamboo more unique than the US, for example?
Um, so let's say, what are we? So we changed the investment banking model. So, kind of like a nice, few second description is that we are a digital investment bank. But we get the data for the structuring of the transaction by going into the company's systems, one way or the other, push or pull, and connecting in and pulling out, what could be a loan tape or the history of the assets or the repayments of in the case of solar panels, the customer's not taking out a loan, but the guy who buys the panel, installs it, and how does the rental stream work and so forth. We get that, and put it into a data lake and then crunch it. But a real amazing transformation out of the traditional investment banking model is that we leave that connection attached. And so then post distribution, we continue to be the data reporter for the deal. And so now what is like investment bank now becomes a Bloomberg, this financial terminal of information. So you transformed like a previously transactional model into a software as a service model. What I say is, later on, as you get like tens or hundreds of deals, you're able to find things that are not really well correlated, and that's a good thing. And you're able to bundle them together. And now you're a company that we admire really deeply in the US called Vanguard, which has the largest index fund in the world. And you're bundling private credit as an asset class. So now what started as investment bank became a Bloomberg and is now a Vanguard. And so that's the path we're on there. Can you do this elsewhere? Our thesis is actually yes, but that Brazil is an amazing market to get it right. Because, again, paradoxically, Brazil has one of the most sophisticated structured credit markets in the world. Here, we can securitize loans to chicken farmers. Good luck doing that in the US. So you could do wildly exotic things here. And the capital markets, the investment markets are somehow used to this. I think it had to here. What happened in the US recently with some banking failures would never happen here. Everything's term funded. People are used to like buying CDs and term and locking up their money, and institutional investors are used to buying credit funds and so forth. So it's a great place to fix the model, to find product market fit. Today, what's our state? We have product. We've now done a couple of deals, structured a couple of deals, and we're tweaking the market fit and answering the questions of what does the economics look like and how does scaling work and so forth. I think we have some pretty good answers. That all coming together, of course, we'll keep investing here, but I think the U.S. is certainly a very, very interesting market to look at. We do have inspirations there as well. To give credit where credit is due. I'm an investor in percent.com, and they just raised their Series B. They do a lot of similar things, more geared to accredited investors, accredited kind of retail investors, so people who have sold a business and who have funds. They can buy these same similar kinds of deals that we do, that we structure. They can buy on the platform there. Perhaps there's opportunities purely unlike what we do on the B2B side. We provide technology solutions for companies and funds, family offices. So let's see.
It seems like, for your business, I mean, just alone Brazil alone, there's a massive market because you can go long tail like the chicken farmer. How many other businesses are out there? And do you approach it from like a sector specific, or are you just opportunistic with whatever comes across your lap? How do you specialize? What's the focus here? How do you decide your go to market?
Yeah, I mean, we have theses on where to look. So I mentioned solar actives. You can also say the electric charging markets. That's also got a cash flow mismatch. The guy has to buy a charger, install it, and then we'll monetize it. There's ERPs, companies, and so forth. So we start with other things, real estate, hydroelectric dams. These are all real cases and companies that we're talking with, logistics companies, edutechs. The more you look, the more you find of a situation where someone made an investment and it's going to take time to recover it. We generally try to start with a case, so now that we can really discuss openly agroforci, that will make our life certainly a lot easier to tangibilize what it is that we do. Um, we we essentially are the partner for your finance team on funding your capital market side, and we do it, uh, provided the deal is large enough, generally over 10 million reais. We can do it with no equity kicker. We can structure a deal that's distributable with no equity kicker, and go from there. So where do we go? Like, how are we building our platform? There's a chicken and egg problem. Again, pardon the pun, that we're talking about loans to chicken farmers at Agroforte. Is we start by structuring the deals, because in a platform you have the challenge of how do you build liquidity on both sides of the platform. So we start by coming with a deal ready and then providing technology solutions to the investors. But over time, as the value of that is proven and shown and made clear, we intend to open up to third-party structures. So now you're allowing anyone who has the expertise and who has the relationships to be able to structure a deal and not have to worry about finding, and communicating with an investor. That's the platform that we provide. And that can actually apply to banks too. We're not. I'm very, very careful, about where we start. We're looking at underserved markets, so our deals typically are that we're looking at helping with are between 10 and 200 million AIs, and our intent is not to do the business that the bigger banks do, but rather to provide them technology solutions also to do those deals better. I'm not going to be able to compete as an institution with their amazing coverage, that goes out to the countryside in Minas and finds, and builds a relationship with a real world company and so forth. But what I can do is help them be able to offer product to those companies at much smaller sizes, and then also really streamline the the process. And same thing, we can help companies streamline their relationships with the banks that they have and the investors that they have.
Would you say it's more of like at that point you become more of an infrastructure play there, and
Yeah,
you're
that's
kind
what
of the
every
infrastructure
platform
layer?
is, an infrastructure play. You need, what's hard is to have the discipline to stop, to not to have the discipline to stay in infrastructure. And the example I would give here is, you know, I suppose iFood has the data and connections that it could open up at some point restaurants, but it never will. It has the discipline to realize, like, you destroy the platform if you do that. You destroy the trust. Your job as a platform is really to make it as frictionless as possible for a hungry customer to find a restaurant. And I suppose there could be a situation where there's no restaurant and you have customers. You can help one get started, I suppose, but you must spin it out as fast as possible. And that's really the path that we're on. Is we want to be the communications network, the facilitator. By having the data of what's going on post deal, you can encourage a secondary market, which helps build liquidity also. So we want to be doing all of those things. We definitely never want to be competing with a side of the market. So, if there's adequate
I
investors
guess I guess
and so forth.
Amazon's the only exception I can think of where they actually start putting their own products on their own marketplace and competing with their. But I guess when you get that dominant, you can get away with it. I don't know.
I'm going to commit to not doing that. Like, even then, like, now they have
I like it.
regulatory issues when they do that. Like,
Yeah,
people
you've
complain.
got to stand by it, and I agree with you. Like when I think it would be a grave mistake for iFood to open up a bunch of dark kitchen restaurants and like have these just digital brands and then compete with everybody, because you lose the trust of your customer there. Then you're in a position where you lose a lot of the inventory that you would normally have, and that there's second order effects of that. So I think it's smart for you to be very clear. And I mean, if you just lock in and focus on that over the next 10 years, you're going to build tremendous value.
Yeah, I mean, the companies we aspire, I'm also not targeting them. They don't work particularly well in the private credit markets. Bloomberg and Vanguard. These are very, very large institutions. So that's the path that we want to be on. But it starts by having access to high quality deals. And if you don't have the relationship with the structures on day one, you be the structure and you find those deals, and then you build the APIs and the processes, and then you open that up to others, and build out the platform. And that's what we're on. This is what I say is, like, if you were to build an investment bank today, this is how you would build it. Like, they don't need to be these fully integrated things, because now there's this thing called platform technology that, again, is very young, and B2B platforms even younger. So that's what we're doing, and that doesn't then mean we're going against those guys. I'll help provide them the tools that they need um, to be as light as possible inside. The look and feel to the customer shouldn't change at all. And so that's what we're building. And I've just been surprised at the rate at which it's actually working out. We start to get requests for help by people who have structured deals to say, hey, how can I explain this better to investors so that they have interest? And we have the tools for that.
What's the general feeling? Because you've seen cycles before. If we think back to a couple of cycles, full stack, and it's good to have like lots of, it's okay to have a ton of assets, and you look at kind of the different sectors where it was like, let's go full stack, let's take in, capital intensive businesses are good, and you can consume all this stuff. And then, you go through different phases. Now it's asset light, and then lending kind of fell out of favor for some people. You're building a technology infrastructure that facilitates lending. So lending itself is one of the oldest businesses, right? And so it's
Yeah.
not going to, but how do you think that affects a business, given that tech companies that are in the lending space are less sexy today?
Yeah, to give a plug to your podcast, I did listen to Fabian's interview with you where he talks extensively about this. And yeah, I leave invigorated because I think our technology encourages or helps companies become asset light, because technology is allowing you to isolate um, the assets of your company and explain what's the cash flows attached to them. And if you can do that, then you can produce a securitizable asset. So, my provocation, would be a company like that, if it can make it really clear how you pay back the capital investment, like in the business plan, you can eventually structure that and sell that agreement to investors. So to a different set of investors who are interested in the fixed income returns. You had asked earlier about how do you think about this versus equity. I think the general trend is this kind of technology allows there to be less of a need for equity because you're better able to segment out fixed income assets to pair with investors who have their own liability stream that they want to pair to fixed income assets. They're looking for fixed income returns, and that's what we're doing. So we enable businesses to become asset light. Before, in the case of the solar panel installation company, it had to go out and buy the placas to install, and then those solar panels have a 10-year life. The economics are great, but they have to sit on this inventory for 10 years, and as a result they were growing, but it quite modestly. Now, over the course of 6 months they raised 5x revenues. By definition, that means you've grown the business 500 times. So we help transform the business from being asset heavy to being asset light. And so I think the pressure to be asset light will continue. And, message I would say is that we are your partner in helping make your business asset light without changing how it works. It's just about, separating out the assets. Maybe a lot of your equity has been tied up in financing working capital. Perhaps that can be put into a financial debenture financeira, they call it in Portuguese, or a fajiki, depending on the size. Uh, we can structure that, or help someone who has structured that explain better to the investors that they're distributing to how this works, and encourage that investment to happen.
So just to wrap up here, you've been in tech for a long time in Latin America, and you seem to be a big believer that debt can play a really important role, and not everything should be about equity. Equity is pretty expensive, right? If you think about it. So just love to hear your general thoughts. Aside from your business, how do you see the debt environment, and what is the future of tech in the region, and how is debt going to play a role for that? SVB was one of the largest lenders of venture financing, right? And they're not, showing up anymore. It's got me thinking about, as I look at my personal banking, I banked with First Republic. Now they've been sold, and probably the debt there will be less flexible. I'm not going to be able to get those interest only
I'm
loans
worried
anymore.
already that you gave me money, Brian.
I know I've got a bad track record here, but SVB, and but who would have thought, right? I guess I'm not the only one. So what does the future look like here in the region? Besides your business, what do you kind of predict? Do you think there'll be more tech companies raising debt as part of the mix of equity? And there's not a lot of debt providers for venture debt. Is someone going to fill that space? Is that What's your kind of prediction for that? And where's the opportunity?
that some like a multi-layered cake here. A lot of layers to this question.
It's a lot to snack on. It's a lot to snack on.
Uh,
But bring us home with your
I'm
with
on
your wisdom
I'm
here.
on the board of Scale Up Ventures with Endeavor. As part of Endeavor really promotes scaling up and giving back, and as part of giving back, I invested in both Fund One and Fund Two, and joined the board, the investment committee of those funds. And it's a passive strategy. So really, the role of the investment committee is to validate that there's a consistent application of rules for how companies go in, and that includes being financed by the round being led by a top tier VC, for example. But I think I was quite worried that there would be no deals, or very limited deals this year. And I've been quite pleasantly surprised that the the the, the fund is seeing 2 approvable deals a month still. And then if I look back last year, perhaps that number was 3.5 uh, or so. So it has gone down, but one message is that the equity capital markets are not closed. What I would say is the quality of the businesses now is just really amazing. I mean, I'm quite excited to be an investor in Scale Ventures, and so then kind of a corollary to that is that then the bar to get funded somehow must be higher, and so perhaps funding got delayed, and then who leaves out of that delay is the more mature companies. So one message is actually one of optimism to say, like, the capital markets are not completely closed. It is true that there's less, so you need to have a business in better shape, and then let's be realistic. I mean, the valuations are lower, um, but deals are happening. On the debt side, earlier this year in Brazil, there was a lot of noise on the failure and maybe even a fraud in some well-known companies, and that did shut the markets briefly. But rates are very high here in Brazil. I mean, most people may not realize outside of Brazil, but the risk-free rate here is nearly 14%. And so there's a tremendous amount of interest that needs to be reinvested in this market. And so the debt markets did not stay shut for very long. And I would say similar dynamics to the equity markets. People are looking harder. The deals are cheaper in the sense that the spreads, the rates that you receive as an investor are higher, but the markets are open. And then, as I described, technology such as what we do at Bamboo is enabling more debt issuances to happen. Even without that, structurally, there's more fintechs and companies with embedded finance. And the real estate market will kick off again. And so there's going to be more. That's a very classic deal where I'm going to invest today and 3 years later, I'm going to have something that's going to produce sales. So I need, someone to bridge that. That's a fixed income investment. All of that's coming. And so the debt markets are going to continue to expand. I think, generally now people are more hesitant and careful about giving equity out, and that's more favorable. I mean, things will get funded, and so if it's not equity, it's debt. Going back to Merton, he became famous on kind of saying equity is a call option on a firm, and the debt's a put option, and together it's a forward on the future value of the firm. And so you're seeing value in transactions shift. So it might be hard to believe, but the current circumstances are quite favorable to the expanding debt markets. And I think we're somewhat lucky and somewhat thematic on how we chose what to do. So we're excited.
That's great, man. Well, I like your optimism. I subscribe to it as well. And thank you for making the time, man. It's really fun to it's funny. I just flashed back to when we first spoke, and I actually remember physically where I was standing when I was on the cell phone talking to you. I don't know, like 2013 or something. Here we are 10 years later, and we've both been through a journey building companies, and then we're starting another company, and then we're investing in both of our companies. So it's
I love this.
It's cool to see.
Yeah, maybe one parting
Yeah.
message is that there's karma in life and there's circularity. Be nice to people. You will see them over and over and over again. And Brian, I've been so pleased to see your story and what you're doing and giving back to Brazil and the rest of Latin America. And I look forward to encountering you again in this life and the next.
Oh man, thank you. You're a great supporter from very early days here with the fund in particular. You jumped in, and you've been, and I'm glad to have you on the podcast because I found out a while ago you're like, oh, I'm a listener. I was like, oh, that's so cool that you listened to some episodes, and so I was like, we got to get you on. And now, your Bamboo is starting to take off and growing like some bamboo, hopefully here. And
Not by accident that we
and
picked
yeah,
this
man.
name. It's fast, it's agile, it's green, it's sustainable,
Yeah,
it grows
yeah,
fast.
it's strong. It's well. Listen, man, you're
All
building a
right.
great foundation of something
Thanks.
that I think is going to unlock a lot of value for companies and shareholders alike. And so, Really happy to be on the journey with you, man. And thanks for making the time.
Anytime. Take care, Brian.